A silent plague is spreading through the heart of America's cities. It isn't a virus. It's a vast, hollowing emptiness. The great office towers, once symbols of economic might, are becoming ghost towers. Mile after mile of empty commercial real estate, gathering dust in the financial centers of the world. Most people see this as a curiosity, a simple after effect of remote work. They are missing the truth. This isn't a curiosity. It's a contagion. Because this is not just about empty buildings. It's about the $2.9 trillion in debt that those buildings are supposed to support. And when that debt implodes, it will not be the skyscraper owners who go down. It will be the foundation of the American financial system, its regional banks. This is the story of the silent crash. It's a crisis that has already begun, and it's following a historical blueprint that has toppled 1,000 American banks before. To understand this crisis, you have to understand a simple, brutal reality. The commercial real estate market is in a state of collapse, unlike anything we have ever seen. Vacancy rates in major cities are at all-time highs. In cities like San Francisco and Chicago, office vacancy is approaching 30%. That means nearly 1/3 of the city's commercial space is sitting empty, generating zero income. Property values have plummeted. A building that was worth $1 billion in 2019 might only be worth 400 or 500 million today. But the owners of these buildings don't have to acknowledge that loss. Not yet. They can pretend the building is still worth its old value, as long as they keep paying the mortgage. The problem is, those mortgages are about to come due. Between now and the end of 2026, nearly $900 billion in commercial real estate debt must be refinanced. Now, imagine you are the owner of a half-empty office tower. You have a $500 million loan taken out when interest rates were near zero. That loan is now due. You go to the bank to refinance, and they tell you two catastrophic things. First, your building is no longer worth $1 billion. It's only worth $500 million. Your entire equity has been wiped out. Second, the interest rate on your new loan won't be 3%. It will be 8%. Your monthly payments will more than double on a building that is generating half the income it used to. This is an impossible situation. You cannot refinance. Your only option is to hand the keys to the bank. This is called the commercial real estate doom loop, and it's happening right now. This is the silent crash. So, why is this a banking crisis? Because unlike the giant Wall Street banks, who offloaded much of their risk after 2008, it is America's small and mid-sized regional banks that hold the vast majority of this commercial real estate debt. For hundreds of these banks, these loans make up 30, 40, or even 50% of their entire asset base. They are not diversified. They are massively overexposed to a single collapsing asset class. When these loans begin to default in waves, these banks will not just lose money. They will become insolvent. Their assets, these worthless building loans, will be worth less than their liabilities to their depositors. And if you think this is just a theory, you haven't been paying attention to history. Because this exact scenario has happened before. It was called the savings and loan crisis, and it was the most catastrophic banking collapse since the Great Depression. To understand the blueprint for our current crisis, we must go back to the 1980s. Savings and loan associations, or S&LS, were once the sleepy, reliable backbone of American local finance. They were your grandfather's bank. They took in local deposits and issued long-term fixed-rate mortgages to local families. It was a simple, stable business model. But in the late 1970s, high inflation wrecked their model. They were paying high short-term interest rates to depositors, but were locked into earning low rates on their old 30-year mortgages. They were bleeding money. In 1982, in a desperate attempt to save the industry, the U.S. government passed the Guarantee, Germane Depository Institutions Act. It was a massive act of deregulation. It allowed S&LS to move beyond simple home mortgages and invest in much riskier ventures: commercial real estate, corporate junk bonds, and speculative land development. The government essentially told these sleepy local banks they could now gamble like Wall Street titans. And to make the deal even sweeter, the government increased deposit insurance to $100,000, guaranteeing that even if the gambles failed, the depositors wouldn't lose a penny. It was a recipe for moral hazard on an epic scale. A speculative frenzy was unleashed. S&LS, flush with insured deposits, began handing out massive, reckless loans for gleaming office parks in the middle of the Texas desert and sprawling condominium projects in Arizona. Commercial real estate became the go-to bet. The market was booming, the money was easy, and the risk was supposedly backed by the U.S. government. Then the blueprint played out. In the mid-1980s, the Federal Reserve, under Paul Volcker, began aggressively raising interest rates to combat inflation. The pin had found the bubble. The high interest rates crushed the real estate market. The speculative projects that had been funded by the S&LS collapsed. The loans went bad. Suddenly, hundreds of savings and loans across the country were sitting on a mountain of defaulted real estate loans. Their assets were worthless. The collapse was breathtaking. Between 1986 and 1995, over 1,000 savings and loans, nearly a third of the entire industry failed. It was a slow-motion banking crisis that hollowed out the financial system. The government was forced to step in, creating the Resolution Trust Corporation to clean up the mess. The final cost of the bailout was over $160 billion, an astronomical sum at the time. It was a direct transfer of wealth from the American taxpayer to clean up the reckless gambling of the banking industry. Now, look at the situation today. Does any of this sound familiar? It is the exact same script, but on a much larger scale. The S&L crisis was triggered by deregulation that allowed banks to make risky bets. The current crisis was triggered by over a decade of 0% interest rates from the Federal Reserve, which pushed banks into taking on massive risk to find any return. The S&LS piled into speculative commercial real estate. Today's regional banks have piled into urban office towers and retail space. The S&L crisis was ignited when the Fed raised interest rates, crushing the value of their real estate assets. Today's crisis was ignited when the Fed raised rates at the fastest pace in 40 years, crushing the value of commercial real estate. The pattern is identical. But what makes today's situation infinitely more dangerous is the scale, the concentration of risk, and the fact that the Federal Reserve is trapped. The S&L crisis involved hundreds of billions of dollars in bad loans. Today, we are talking about trillions. The risk is hyper-concentrated. While the big Wall Street banks are somewhat insulated, hundreds of regional banks are existentially exposed. These are the banks that provide the loans for small businesses, for car dealerships, for the real, productive economy. When they fail, credit in the real economy freezes. But the most terrifying difference is the Federal Reserve's inability to act. During the S&L crisis, once the inflation of the early 80s was broken, the Fed had the freedom to cut interest rates, which helped put a floor under asset prices and ease the pain. Today, the Fed is in a box of its own making. They are facing persistent, stubborn inflation. If they cut interest rates now to save the regional banks from their real estate losses, inflation will reignite and spiral out of control. If they keep interest rates high to fight inflation, the commercial real estate market will continue to collapse, guaranteeing the failure of hundreds of banks. There is no escape. They have no good options left. They are trapped. The collapse of Silicon Valley Bank in 2023 was the first tremor. It wasn't a commercial real estate failure, but it exposed the fundamental weakness of these regional banks. Their balance sheets were filled with assets in that case, government bonds that had crashed in value due to rising interest rates. Commercial real estate is the next, and much larger, shoe to drop. It is a crisis that is already baked in. The defaults are coming, It's a mathematical certainty. So what will happen? We will see a wave of regional bank failures, far greater than what we saw in 2023. At first, the government will try to contain it. The FDIC will step in. They will orchestrate weekend takeovers, forcing the giant too big to fail, banks like JP Morgan Chase and Bank of America, to absorb the smaller, failed banks. This is not a solution. This is a consolidation of power. The crisis will be used as a justification to further centralize the banking system, wiping out the small and mid-sized players and leaving only a handful of financial behemoths in control of the entire system. It is a massive transfer of wealth and power happening under the guise of a rescue. But the problem may be too big to contain. The losses from commercial real estate could be so vast that they trigger the one thing the powerful fear most: a crisis of confidence in the system itself. This is the silent crash. It is not an if, but a when. The blueprint from the savings and loan crisis gives us the exact pattern to watch for. A vulnerable banking sector, overexposed to a collapsing real estate market, being pushed over the edge by a restrictive Federal Reserve. This isn't a black swan event. It's a gray rhino sitting in plain sight that everyone in power has chosen to ignore. They are hoping to manage the decline, to orchestrate a controlled demolition. But history shows that these events have a way of spiraling out of control. The story of the savings and loan crisis is a warning. A warning that when the foundation of a bank's assets proves to be sand, the entire structure comes down. And right now, hundreds of American banks are built on a foundation of empty, decaying office towers. The silence is the most dangerous part, because when this crisis finally hits the headlines, it will be far too late to prepare. If you are ready to continue decoding the financial myths that shape our world, subscribe to Economythics and click the notification bell.